Thank you for joining us at xm.com for today's market comment by Marios Hadjikyriacos. I'm Maria Bashardabis. Another blockbuster employment report highlighted the resilience of the U.S. economy on Friday, pouring cold water on bets of imminent Fed rate cuts. The American economy added 353,000 jobs in January, nearly double what economists had projected, while last month's figures were also revised higher. In another sign of strength, wage growth accelerated to hit 4.5% in yearly terms, fueling concerns that the war against inflation is not quite over. Markets interpreted the stunning jobs numbers as another sign the Fed won't begin the rate-cutting process in March, reinforcing the latest messages from Chairman Powell. The probability of a rate cut in March fell to 15% in the aftermath. For the entire year, 5 rate cuts are now baked into the cake, down from nearly 6 before this dataset. With traders pricing in a higher for slightly longer path for interest rates, the U.S. dollar powered higher, riding the wave of rising yields. Losing the most against the dollar was the Japanese yen, which fell almost 1.5% on Friday as the rift between U.S. and Japanese yields grew wider. The next event for the dollar will be the release of the ISM Services Survey for January later today. Shares on Wall Street closed at new record highs last week as signs of a robust labor market and reassuring earnings from the tech sector helped the market brush aside the threat of delayed rate cuts. The S&P 500 erased an early decline following the non-farm payrolls numbers and instead climbed to hit new uncharted heights with some help from stellar earnings by Amazon and Meta platforms. Equity markets are currently enjoying the best of all worlds. The U.S. economy and consumer spending remain resilient. The Fed will ride to the rescue by cutting rates if growth falters. And in the meantime, investments in artificial intelligence are juicing up earnings. No wonder then that stock markets just won't stop rallying, despite valuations being so stretched. Even some warnings from Donald Trump that he could impose tariffs exceeding 60% on Chinese goods if he is elected in November did not dent the cheerful tone in the markets. Crude oil prices came crashing down last week, unable to capitalize on solid economic data, the cheerful tone in equities, or the latest attacks by the United States against Iran-backed targets in Iraq and Syria. Thanks for watching today's market comment here at xm.com.